So hey, what's up guys? And in this video, I want to do a quick update on Disney, which is actually one of the positions I covered on this YouTube channel on how to make $10,000 from this stock. Because my son is sleeping at the moment and it's kind of late at night, um, I'll speak a little bit more quietly. So if you need to turn up the volume, you can turn up the volume. So previously I said Disney is a good buy. It is at a discounted price. The theme parks are reopening and we know it's packed. A lot of people are going to Disneyland. The movies are coming out and they're doing great. Disney Plus is getting a lot of new contents like Star Wars, Obi-Wan Kenobi, Book of Boba Fett, Mandalorian. The Disney movies are also being put on there. So there's a lot of content and it is growing as well. So then the fundamentals of the company is doing great. Now, previously I said that the entry range is somewhere between 135 to 110. So that is already at a very good discount. And if you compare that to 2020, then you'll see that, hey, it is almost near the COVID level area. So some of you ask me, what is the deal with Disney now? Did my view change on Disney and what you should do? Now, within Investing Accelerator, we have a much more complicated strategy that uses option. But on this YouTube channel, I want to focus on stocks and shares because there's no time limits when you're investing. So if you're using shares and you got into something at a discounted price, all you have to do is to hold on to it. There's no magic to investing if you're just using shares. If you got a discount, you hold through the dip and then you'll come out on top. And what's important to focus on is the fundamentals of Disney. And even though right now Fed is increasing interest rates, there's a Russian-Ukraine war, people are still going to Disneyland. People are still traveling, the movies are still on, it's still getting a very good box office. So all of these factors put together makes Disney a very fundamentally strong company. Now within Investing Accelerator, we use options. We can long or short the market, which makes it a lot more flexible. In fact, we can simultaneously long and short the market, which is what I did in this case. So previously I entered into Disney around 130, which is a small position to start because I know that Disney has a very high chance of dropping because of the short-term issues with Florida, the government, LGBT community being on the news, and there's a lot of conflict there, and it went down. So at this point, what we do in Investing Accelerator when we see there's some sort of unforeseen event is we use a hedge. So we would buy a put option to reduce our risk. So the first time I did it, the amount of money we use in the hedge returned around 40% within a couple of weeks. So you can see for these weeks, it is actually dropping. So, and then I took profit, and then afterwards we assessed the situation again. And my understanding at that time was that I think there's still risk. I don't think we're in the clear yet, so we want to have another hedge position. So I entered into a second hedge position after taking profits of 40%. And now we can see that, the market is very scared. Fed is looking to increase interest rate this week, so there's a lot of fear there as well. And it went down to $95. So just today, Monday, I took profits on my second hedge, making 70% return. So when you are investing using shares alone, it's very simple, right? You buy, you hold, and you have a good exit. So you need to focus a lot on having a great price, average down if possible, and then having a good exit. So as long as the fundamentals of the company doesn't change, you don't really need to watch it every day because it doesn't really help you, because all you're really waiting for is to hold through the dip. If you're using options, hedging, it gives you a lot more flexibility. It allows you to design to cover specific risk like what we're seeing right now, for 6-8 weeks. Now, if you are long-term holding and you kind of zoom out, and if you got in at a low price, right, then what do you need to do? All you have to do is hold. It's very simple. But if you know how to use options, you have that flexibility to make some money in the short term. Now, this money you make from hedging, it doesn't bring you to profitability. what it does is it helps reduce your loss, let's say by 30, 40, 50%. And then when the market recovers, you have that gain from hedging as well. So that is really the purpose of hedging. So you can see here, I hedged twice, first time making 40%, second time making 70%. That's basically it. For my long-term position, it is still at a loss in the moment, but I'm a long-term investor. So you actually wouldn't worry too much about that because you know I'm making money on the way down, and when the market is recovering, my long-term position will be profitable again. So then it's kind of like making money both ways. So it's just a matter of timing. So if you want to hedge, you actually need to be even better at your exits. If you are just using shares, it's very simple, right? You buy, hold, sell at a higher price. But if you hedge, you also need to have a relatively shorter term view, and you also need to kind of design using the least amounts of money possible for a hedge to reduce your risk during that time, because when you're using options, there's an expiry date. So you need to be more accurate, and you need to pay a little bit more attention per se, but you don't need that much time on it. I would say an hour or two a week is probably more than enough to manage your portfolio medium long term. So even in this case, you can see I hedged Disney twice, from here to here, and then from here down to 95. So for Disney, it might go down to 90, but I mean, making 70% itself on the hedge, I'm already pretty happy. And I reallocated that into some of my other long-term positions to average down. So I'm really positioning myself to enter near the bottom of the market. Now, of course, the big question is, no one knows what the bottom of the market is. But what you can do is to design a strategy that enters over time, even if you don't know the bottom of the market. And that is really investing. You're dealing with probability. You're dealing with uncertainty. And if you're using buy and hold shares, it's very simple, which is great. If you're using options, then in a way, you can design any strategy you want. You can design any risk to reward you want. And that ability and that power is sometimes too much for the regular people if they don't know how to design a strategy that works well for themselves. So you can design a very good strategy, and you can also design a very bad strategy. So if you don't know the risk and reward, what you can or cannot do with options, then it's very easy to lose money with options. So that's why when you're using options, you need to focus a lot on the design, on the strategy. When you're investing using shares, it's just buy and hold, great fundamentals, great technical, and you're pretty much done. But when you're using options, there is that additional layer of risk, which is why I don't cover it on the channel extensively, because it requires such deep understanding and so many variations of it, it's very easy to make a mistake. And when it comes to investing, it's all about these high certainty trades that you place that you are very confident in making money. And I can use a very simple example. We have Disney here, blue chip entertainment company. And we have another, let's say, small cap EV stock that is losing money. So if you compare it between the two and you want to hold them for 2 years, which one would you choose? Well, the answer is probably Disney, right? Like the chance of you losing money will be a lot less with Disney. It's blue chip. I mean, if you lose money with Disney, probably you're not going to be making money with EV stock during this period as well. So when you compare the risk and reward, look at the stability of the company, the probability of profit, everything together would gear you towards safety. And that's how you should think when you're investing. And it's kind of an important skill to learn. It's more like a mindset change. So when you are looking at a position, you entered, let's say 110 into Disney. It's already a fantastic price. I mean, Disney was previously as 200. You entered at almost 40% off. I mean, that's a great deal if you're buying a shirt. It's a great deal if you're buying a car. So why is it not a great deal if you're buying a company? So that's how you should think about it when you're investing. And if Disney goes to 95 in the short term, well, are you going to lose sleep over it? If you are, then that means you invested too much, so reduce your allocation. If you are worried that Disney will go bankrupt, then, well, maybe you should look at the financials and see if Disney is a loss-making company. Are they not making money? Are they like having a failing business? And so far, everything within the fundamentals is pointing towards Disney being a great company. So that's just a glimpse of how we invest within Investing Accelerator, how we reduce the risk even in such bear markets, and how you have more flexibility to position yourself when it comes to investing, basically giving you the power to protect yourself within a certain period of time. And if you just use shares, then well, you can't do that. And I personally know mutual funds that their investment mandate is to buy and hold, right? They focus on investing in value stocks that grow year after year, and they buy and they hold, and perhaps they exit. Sometimes they don't even exit, they hold it for 20 years. So when you're thinking about that, do you want to have the ability to hedge? Because the mutual fund that has the regular buy and hold investment mandate cannot hedge. They cannot do that for you. So you only can do it for yourself. And to do that, you need to assess the current environment to see if it is worth it to hedge, how much to hedge, when to hedge. And that is a skill that one can learn. And yeah, that's kind of what we teach in Investing Accelerator. So if that's something that interests you, then you can watch the free training within the description. I'll put it in the first link. It's 2.5 hours. It kind of outlines how I invest, how I use options partially, how I analyze a stock to make sure they are great companies that are safe to invest in, and you are investing at a discounted price. So my entire investing strategy is built on the foundation of getting discounts. So it's all about value investing and then multiply our profits using options or creates monthly passive income if you're closer to retirement. So that's kind of what we're trying to achieve here. And the goal is to get 30% return. So yeah, that's a quick update for Disney. So it's great that it is at a discount because if you're watching this video for the first time, it's $95. It's super cheap. So it's just a matter of waiting for a bottom to form. And if you're planning to hold on to Disney for 18 months or more, then hey, this is a great buy, no brainer. So I'll see you in the next video.